Excel Industries' performance in Q1 remained weak with a dip in revenue and profits as well as margins, majorly due to poor sales amid delayed monsoons. Let's do a three-point analysis of the earnings fine print and the outlook on the company. 1. What are the Q1 earnings highlights? Well, the top line was down 2.7% year-on-year. Now, there was a sharp 30% year-on-year decline in EBITDA along with an 871 basis points margin contraction as well. However, the company has rapidly paid off the debt on its balance sheet and has reduced it to near debt-free levels. Reduced debt bodes well for margin improvement and provides strength to the balance sheet, which could be a positive for companies' long-term expansion plans. Now, the company's product profile has seen a healthy demand growth. There has been a sharp growth in generic agrochemicals due to strong demand. Excel is also a visible player in the specialty chemicals market. Now, the industry has faced intense price competition in the past. However, the Chinese situation, wherein we have seen closure of Chinese factories, has helped in improving realizations and margins for the Indian players, which is expected to continue in the future as well. Excel also deals in manufacturing of specialty polymer adhesives and also inputs. Now, it is expected to retain and grow its market share here. The company also manufactures pharmaceutical APIs, which have seen a growing demand in the recent years. Excel has also ventured in veterinary API manufacturing, which is seeing strong growth as well. Foray into human API would be another growth trigger for the stock. Now, the return on capital employed has also remained strong and improved in the last years with around 35% in FY19, which is much higher than its listed peers and also beckons attention. 2. What are the key risks to the growth going forward? Well, delayed monsoon impacted the Q1 performance of the company. Nearly 50% of the company's products are being used in the agrochemical industry, and the demand for these companies' products are highly linked to the monsoon performance. This exposes the company to downside risks as well. Yellow phosphorus is one key raw material for the company's products. The prices of yellow phosphorus have been quite volatile in the past, and sharp price movements could impact the company's margins. The close down of many factories in China due to stricter environment protection norms had also worked in favor of the company in the last years. However, there is a news of restart of production for one of the Excel's products, which might have an impact on demand. 3. What's the outlook on the company? Well, at Moneycontrol Research, we remain optimistic on the long-term prospects of the company. We also see the business as a strong, growing business, generating a strong return on capital. With Chinese factories closing down, we believe that it is a golden time for Indian chemical companies to capture the market and expand both in domestic markets as well as internationally. Now, the current valuation reasonably is fair and is therefore all the investors can look at accumulating the stock with a long-term perspective.